think, Adrian, in the interest of time, I suggest that you take us through the program.
Okay. Okay. Good afternoon, everyone, and welcome to our webinar on EAC domestic tax regimes and the proposed measure for 2022-23 budgets. From our program, I think we will start with remarks, welcome remarks from our Executive Director, Mr. John Bosco Kalisa. Then we will have open remarks from our Vice Chair, Uganda Chapter, Mr. Simon Kaheru. After that, we will have an update on progress on harmonization of domestic taxes in EAC from EABC Secretariat. We were expected to have Dr. Pantaleo Kesi from EAC Secretariat, but he's busy with other commitment in Zanzibar. He could not be with us today. Thereafter, we'll have a presentation from PwC team from Tanzania, Jonia Kashabala and Jafari Mbea, who will present us domestic tax regime in Tanzania. We are looking at value-added tax, income tax, and excise duty, and some of the proposed. Thereafter, we'll have another presentation from Kenya, where Hannah Wanyoke and Andrew Rugai, PwC from Kenya. Then we'll have a question and answer and some discussion. After that, we are going to have another presentation from Uganda, where Lukanga and Juliet will make presentation on the domestic tax regime in Uganda. Then we'll have another presentation from Rwanda, where we are going to have a presentation from Messi, Ndirangu, and Mwenda Ruito. After that, we are going to have question and answer and discussion. Then we will have a closing remarks. So I think I will go through some of our rules and the ground rules. And we are requesting all to mute your microphone and video when you are not speaking. Then also, we expect you to contribute to the meeting goals, which is going to focus mainly on the domestic tax in EAC. Stay on point and on time. Question can be sent to the chat rooms and during the question and answer session. Meeting will be recorded for reporting purpose, and the report of the meeting will be shared. So without much ado, I welcome Mr. John Bosco Kalisa, EABC Chief Executive Officer, to move the welcome remarks. Karibu ED.
Yeah, thank you very much, Adrian, and good afternoon, everyone. Good afternoon, all our panelists. Good afternoon, our chair, Uganda chapter, and vice chair. And also, I would like, before I deliver my remarks, welcoming remarks, to first of all appreciate the efforts and the support extended to EABC by Coca-Cola. And I really want to appreciate them for supporting us in this exercise, very important exercise, when we are discussing, dialoguing on matters pertaining to domestic tax. Allow me again appreciate and recognize Mr. Simon Kaheru, our EABC Vice Chair, Uganda Chapter, and a board member, and the Chair of the EABC Policy and Advocacy Committee. Thank you, Chair, and you are most welcome. I know you will be delivering the key remarks, but I wanted again to recognize your presence and support in this endeavor. Allow me also appreciate and acknowledge the panelists from PwC across the region for their dedication, commitment, and insight they've been giving on domestic tax, especially the inputs, their synopsis input to the budget. They've been doing a great and a commendable job. EABC really appreciates your insight and your technical expertise in this area. Also allow me to acknowledge all the participants across the region from both our governments, NGOs, donors, private sector champions who are already on this call. We can see the number is growing, and I really want to welcome you and ensure you that this is we have eminent panelists who are going to do a justice to this topic. Maybe before I dive deeper into my remarks, I wanted just to give a few insight that taxation is one of the important tool for our development. It's an important tool for the development, and we should always appreciate and acknowledge our government in terms of using this tool in terms of delivering public goods. We need security, we need infrastructure, we need education and health-related services. We can only do that when we have a very thriving, private sector. I would also want to really appreciate and thank that the EAC Secretariat that have been very key in terms of engaging us, working closely with EABC, in terms of our technical working group, where these issues that are related to fast-tracking customs union, common market, monetary union are discussed and debated upon. I know we have, as I said, we have eminent colleagues, team from PwC, who will do justice in terms of the topic. But I wanted to highlight an important articles that does strongly urge our region to harmonize domestic tax. So tax harmonization has been emphasized in all the stages of our EAC integration, customs union, common market, as well as monetary union. So the legal justification of domestic taxes is provided in the following articles. We have Article 83, paragraph 2 of the treaty establishing East African Community, which obliges the partner states to harmonize their tax policies with a view to remove tax distortion in order to bring more efficient allocation of resources within our community. The Article 75, paragraph 6 of the EAC Treaty also does obligate EAC partner states to commit themselves to refrain from enacting those legislation or applying administrative measures that directly or indirectly discriminate against the same or like products of other partner states. I also looked at the Article 15 of National Treatment of the Protocol on the establishment of East African Community Customs Union, which also bars EAC partner states from using discriminatory and administrative measures or internal taxes on imported products from the EAC partner states against similar domestic products. Article 32 on harmonization of tax policies and the laws of the Common Market Protocol, it does state that the partner states undertake to progressively harmonize their tax policies and laws on domestic taxes with a view to remove tax distortion in order to facilitate the free movement of goods, services, and capital, and the promotion of investment within the community. The Article 8 of the East African Monetary Union does also provide clear guidelines in terms of harmonization and coordination of fiscal policies and the avoidance of harmful tax competition. The tax neutrality is very critical for the good functioning of the customs union and the common market. So I think all the stages, all the protocols does highlight the importance of domestic tax harmonization. And the key word is that harmonizing domestic tax means that our resources will be efficiently allocated and will be able to attract our regional and multilateral investment in the region. So the overall aim of this tax harmonization for the ESC partner states, again, as I mentioned, is to ensure efficient allocation of resources. So we've seen that in a number of years, again, I recall from 2012, there has been a clear guidance in terms of how we should approach the tax harmonization exercise. And there has been also very divergent views in terms of harmonization exercise. You know, some of the economists do argue that it is not important even to harmonize the tax rates. Countries can individually have their tax rates, but what is important that is clear, the common nomenclature is that we need to have clear rules and regulation with regard to the domestic tax harmonization, and we need to set a clear framework for harmonization. So today, EABC webinar will enable the private sector stakeholders to get insight into the disparity of the domestic taxes across ESC, as well as various tax awareness of the challenges, as well as the tax measures proposed for 2022-2023 budget. This in turn will create awareness of the challenge brought by an harmonized domestic tax regime in our region. And I'm sure that the panelists here will also share their insights on the best practices where the tax harmonization, especially from EU tax model, where the harmonization has been able to produce tangible results in terms of the domestic tax contribution to their GDP. So as the apex body of the private sector and the EABC provides a platform through which the business community can seek targeted policy reform in order to promote and operate a conducive business environment for growth and the thrive of our business. As part of this mandate, EABC has been at the forefront of advocating for harmonization of domestic tax regimes across the region. So there are various key initiatives we've been undertaking as EABC, which includes organizing private sector regional workshop on harmonization of excise taxes that since June 2020. We've also organized a regional public-private dialogue on harmonization of domestic taxes in the ESC in collaboration with our secretariat. We've had a number of PPD dialogue discussing various codes related to domestic tax harmonization. Allow me also appreciate and record that under our technical working group with the ESC Secretariat, we've been able to table a number of measures related to domestic tax harmonization. And we continue that effort to ensure that we achieve a very win-win situation. So under this webinar, we have three expectations from this webinar. One is that we need to understand deeply the ESC domestic tax regime, and what are the divergence areas and what are the convergence areas. We need also to see the progress that is being made by the Fiscal Committee on harmonization of domestic taxes in the ESC. Again, we need, as EABC, through support from the Coca-Cola, we need to continue raising awareness and engage our private sector, both at national and regional level, to understand the challenges of an unharmonized domestic tax and the need to put more efforts in advocating for harmonization of domestic taxes. So I think with those few welcoming remarks, allow me to again say that a good tax is the one that has the following important contribution or canons. One is the convenience, the second one flexibility, the third one equity, the last one is the optimal realization or optimal economy. Those were the canons that were put forward by the father of economists, Adam Smith. So those canons should guide our reform in terms of harmonizing tax. We need to ensure that there is an equitable distribution of gains and benefits accruing from our tax. With those welcoming remarks, I want to thank everyone for engaging into these fruitful deliberations. Asantini.
Okay, thank you very much, ED, for the very interesting welcome remarks. Now I think it is time to welcome Mr. Simon Kaheru, EABC Vice Chair, Uganda Chapter, and also the Chair of Policy and Advocacy Committee of EABC. Welcome, Mr. Kaheru.
Thank you, Adrian, and thank you, ED, for highlighting very strongly those points, very clear remarks, and setting the scene for the important discussions we're going to have this afternoon. ESE Secretariat representatives, our Chief Executive, Ndugu JB Kalisa, our East African Business Council partners, this afternoon's webinar, PwC, and the Coca-Cola Company, who have a representative here besides myself, all our panelists, participants, members of the media, ladies and gentlemen, allow me to start by thanking you on behalf of the board of the East African Business Council for taking time out of your busy schedules to participate in this very important webinar. The title, as elucidated clearly by our ED, our CEO, is ESE Domestic Tax Regimes and Proposed Measures for 2022-23. And we know that this discussion is extremely important, especially at this point in time, when the ESE partner states unveil their budgets for the new fiscal year. This selection is quite deliberate, and I once again thank PwC for being a very essential part of that decision-making. Today, we know that Tanzania, Uganda, and Rwanda are poised to read their budgets, which they are going to present in June. Kenya has already unveiled its budget, which they did earlier, not out of disrespect of our protocols and arrangements, but because of the national elections that are due in August, which elections, I must highlight, also have an impact on the budget process itself, on the budget contents. And Burundi is yet to align its fiscal year with the other ESE partner states, same as South Sudan and our newest entrant, the Democratic Republic of Congo. Highlighting this issue of tax harmonization at this point is extremely important for all of us as East Africans. We hold these webinars and discussions because tax matters impact businesses, but most importantly, impact our people. And what we're aiming for, all of us in the private sector, is to see pro-people budgets across East Africa in the 2022-23 fiscal year. Obviously, because of the ravages of the COVID-19 pandemic, but also the ongoing impact of both that pandemic and other exogenous, we call them, factors like the war that we are seeing happening in Europe. As you're all aware, under the ESE Customs Union, which came into force in 2005, the ESE partner states agreed to apply harmonized customs duties on the products that we import from the rest of the world. We implement this through the application of the Common External Tariff, CET, which has been largely followed and respected by all the countries, but which keeps on getting ratified and taken more seriously. And at this point, allow me to commend the ESE ministers responsible for trade, industry, finance, and investment for finally agreeing, after many years of deliberation and discussion, on the 35% band as the maximum rate for the 4-band tariff structure. The comprehensive review of our CETs has taken more than 6 years, which is too long a time when you think about it in business terms. The decisiveness with which our ministers took this decision gives us much hope that we will overhaul the CET and ensure that it works for the private sector and for the people of East Africa. This milestone shows that our trade relations between the East African Community Partner States and the rest of the world will be more regular and more positive, especially for the growth of business and our economies. Today, we are going to hear from the eminent panelists and the persons participating, who you're all urged to please participate, on harmonizing domestic taxes. We know that a community of this nature cannot be successful if there's disparity in our economic and fiscal policies. We know that each East African community state will retain its mandate over their internal domestic taxes, whether it's income tax, VAT, or excise duty. And the duty structures and rates are developed and managed at the national level, basing on national interests and each country's policy priorities. However, what we're all working towards is seeing a closer harmonization that will enable each and every one of these partner states to move as one region, one progressive region, a progressive region that is going to advance at the same rate for all the peoples of East Africa. We want to see harmonized taxes so that we have fewer negative effects on the rights and freedoms of the people and the businesses within East Africa. And we want to see this enhancing the integration of the East African community. The main objective of our discussion this afternoon is therefore to get insights into the domestic tax regimes of each one of these countries. And as the ED highlighted, we will be receiving a number of presentations that are country specific, but also the coalescence of the ideas and suggestions that will focus on the East African community being one solid community of close to 300 million people, coast to coast of this continent. Our panelists are very competent, and we applaud them for showing up in good number, except for the one apology we have. And we look forward to this webinar being an eye-opener, both for us as the private sector and for policymakers. As the private sector, I urge you to pay very keen attention and take as many learnings as possible, because you have a very key role in influencing the policymakers. As the East African Business Council, we are the umbrella of the private sector and growing business, because we know very well that the East African Community Charter says East African community integration will be private sector led, but people-based. Part of that private sector leadership is us speaking truth and power to politics and policy. So let us address this afternoon the disparity in our domestic taxes across East Africa, the implications on the businesses and the people of East Africa, and come up with clear recommendations that will make this place, this region, an attractive destination for investment and trade. So I wish you all fruitful deliberations for the good of the people of East Africa and indeed Africa as a whole. Asanteni sana.
Thank you very much, Vice Chair, for the open remarks, which actually will make our presentation and discussion very easy, because you have already set us what we need to achieve, where EAC can have a tax which has a negative effect in the allocation of resources in the EAC. Now, as an introduction, I'm going to make a very brief presentation on the update on the progress on harmonization of domestic taxes in EAC. As I said earlier, we were expecting to get this presentation from EAC Secretariat, but due to the other commitment, our colleague from the EAC Secretariat could not be able to make the presentation. So my presentation will have just 4 slides where I will briefly talk about EAC as an evolving project. Then we'll talk about EAC integration and key milestone. Then I will go to the harmonization and coordination of domestic tax at EAC. And then I will end up with some of the challenges of harmonization domestic taxes. If we can see, EAC integration process actually started long time ago, where the 3 countries, which is Kenya, Tanzania, and Uganda, have been enjoying a long history of cooperation. And some of this type of integration were the customs union between Kenya and Uganda, which was in 1917 during the colonial era. And also Tanganyika joined this customs union in 1927. Then we had the East Africa High Commission in 1948 up to 1961, when the 3 countries actually gained their independence. After that, we have the East African Common Service Organization from 1961 to 1967. And then we have East Africa Community, the first one, from 1967 to 1971. And here we had a lot of achievement where we achieved common services like railway, air transport, and a lot of services in that particular area. After the collapse of the former EAC community in 1977, the 3 partner states agreed to explore areas for future cooperation and make concrete arrangement for that cooperation. So we saw that in 1993, the agreement for the establishment of the permanent tripartite commission for East Africa cooperation was established. And you see from there, that's when we start actually forming our East Africa community. And the treaty for the establishment of the East Africa community, the new one, was signed in November 1999, and it entered into the force on 7 July 2000. Some of the milestones in the new EAC East Africa community, one was the EAC Customs Union, where you find that the protocol for the establishment of the Customs Union was actually signed in 2004, and the implementation of this Customs Union started in January 2005. And the good thing about this, Rwanda and Burundi become full member of EAC in 2007, and they start implementing the Customs Union in 2009. And from there, we have achieved a lot, where we have a common external tariff. We have also East Africa Customs Union Custom Management Act, one law, which is implemented by all of EAC country. We achieved a full-fledged customs union in 2010 after the partner state actually removed all tariff for EAC originating goods. Then we started also single custom territory, where tax are paid at the first point of entry, and this facilitates free movement of goods across the EAC. Then we have a second stage of integration, which is a EAC common market, where we see the protocol which was signed in November 2009. And the customs common market protocol came into force in 2010. And we From there, we have achieved progressive free movement of goods, person, service, labor, as well as capital. But also, we are enjoying two rights, right of residence, as well as right of establishment for the legal person, which are companies. Also, we have currently progressively implementing monetary union protocol, which we have given a 10 years as a roadmap. And we expect maybe to start East Africa Monetary Union maybe in 2024 after putting in place all the conditionality for the monetary union. Other achievement is we have a Republic of South Sudan, which joined in 2016 and become a full member in 2016, the same year. But also currently we have also allowed Democratic Republic of Congo to start a process of doing the accession and become the full members. And we're expecting the Congo to send the treaty for accession to EAC by 14 April. I think we sent the DRC has already sent the treaty and they are doing ratification. After that ratification, it will become official member of EAC. On the area of harmonization and coordination of domestic taxes, as the chairman and ED said, you find that the all stage of EAC integration actually emphasized the need for harmonization and the coordination of the domestic taxes. And some of the initiatives or achievement, you find that we usually each year have the pre-budget consultation of the ministers of finance of the EAC partner state, where actually they meet and they agree on how they are going to align their budget and some of the tax issues before the budget. This year, they have already met. They met on 13 this month in Mombasa, and they have agreed a lot of issues which they need actually to incorporate in their national budget. Apart from that, we have what we call harmonization of the budget or financial year for the EAC partner state, which ran from July to June. It is only Burundi which has not aligned the budget year, and we expect the Burundi will come, will join the other EAC partner state. But also from there, you find that usually partner state agree to read the budget on the same day. Another area on the harmonization of domestic tax is signing of the EAC agreement for the avoidance of double taxation and the prevention of the fiscal evasion with respect to taxes on income, where all the 5 partner states signed this agreement on 30th November 2010. This agreement is supposed to be ratified by all the partner states, and all the partner states except Tanzania and Burundi have already ratified the agreement. So once Tanzania and Burundi ratify the agreement, it will come into force, and it will address the issue of double taxation as well as fiscal evasion with respect to taxes on income. Another area is establishment of the institutional framework for harmonization of domestic taxes, where we have technical working groups. Then we have a technical committee for harmonization of domestic tax. Then we have a physical committee, which is formed by customs from all the partner states. And then from there, we have a sectoral council on finance and economic planning, where the minister actually meet and discuss various tax issues. But also we have a lot of studies which has been conducted, supported by GIZ and other stakeholders like IMF, which actually address some of the challenges on tax in EAC. But very importantly, we have the EAC policy for harmonization of domestic taxes and agreed on the areas of harmonization. We also have EAC model, tax treat. We have also EAC tax treat policy, and we have a draft EAC code of conduct against harmful tax competition. So we have a lot of document with regard on harmonization of domestic tax in EAC. Some of the key area in the harmonization and the EAC policy for harmonization of domestic taxes include, for example, in the income tax, partner states have agreed the harmonization will incorporate principle of income tax, for example, corporate income tax, individual income tax, international taxation, and transfer pricing, as well as EAC avoidance of double taxation agreement, as well as policy. With regard to value-added tax, also you find that under the framework, partner states have agreed to include destination or source principle when we are talking of VAT, exempt and zero-rated supplies, exempt person, determination of tax rates, value-added tax treatment of cross-border, as well as imported services, procedure, as well as rule for refund, rule for differentiate sectors, age, for example, financial intermediation, agriculture, extractive industry, and place of supply of services. On the excise duty, you find that in the area of determination of dutiable goods, that is one of the area partner states have agreed to go on, and also services, and as well as excise duty rate, where partner state maybe will agree on the duty base, duty rates, and the excise type, either if it's a specific, ad valorem, or hybrid, where you mix both a specific and the ad valorem. But also another area is the determination of rules of local content, which I think also the private sector needs to agree in that particular area. Regarding the challenges for harmonization of domestic taxes, first, I think there is inadequate funding and shortage of staff in the fiscal and monetary affairs department of EAC, which apart from dealing with a lot of issues, they deal with taxes, they deal with monetary union, the capital market. So you find that there is a lot of activity in that particular area. Another challenge is there is a general no political will to move forward with the harmonization of domestic agenda. Why? Because some of EAC partner states are fearing that the harmonization of domestic taxes may erode their policy space of using domestic tax policy instrument. As you know, for example, currently the partner state cannot actually maneuver with the customs duty because they have to agree at a particular with the other EAC partner state. Now they are fearing, for example, if domestic tax is harmonized, maybe they may fail to get that space. Another challenge is some of the EAC partner states have perceived fear that there will be revenue lost due to the harmonization of domestic taxes. Another challenge is the system of harmonizing the domestic taxes regime is too long and also bureaucratic. You understand under EAC, everything needs to agree by consensus. All the partner states have to agree. And when you look at the current roadmap, you find that partner states have agreed to progressively harmonize a domestic tax, where they will start with the excise duty. After that, then they will go to value-added tax. After that, they go to income tax, and then subsequently end with tax incentives. And for private sector, they think maybe this will take long because they want things to happen now. Another challenge is that the EAC private sector is not united in their position, for example, when we are talking of the local content, because, and especially when we are talking of excise tax, mainly due to protection afforded by different tax regime, where local content currently is considered as national rather than regional. So I think that is the end of my presentation, and I end here. Now I'm changing from the presenter to the moderator, so I can welcome now Jonia Kashabala and Jafar Mbaye, PricewaterhouseCoopers in Tanzania, to make a presentation on the domestic tax regime in Tanzania and some of the proposed domestic tax measures for 2022-23 budget for Tanzania. Welcome, Jonia and Jafar.
Thank you, Adrian. Jafari is trying to put up the slides.
Okay, maybe you can. Okay, you can briefly introduce and then you start the presentation.
Sure. Okay, I will start with an introduction as Jafari is putting up the slide. My name is Jonia Kashalaba. I'm a senior manager specializing in taxes at PwC Tanzania. So, Adrian, we're going to change the structure of the presentation a little bit so that we can do a comparison. In terms of domestic taxes, we thought it would be better to do a comparison so that you can see how the rates in one country compare to the rest of the region. So we'll start with the presentation on domestic taxes, covering all the countries, and then later we'll do a presentation on the proposed budget changes for the financial year 2022 and 2023.
Okay, that is okay.
Next slide. Yes, and then we are going to take all the questions at the end once everyone has presented.
That is okay.
In the meantime, if you have a question as we present, please feel free to put them on the chat. And then my colleagues will also introduce themselves when they present. Okay. So as a starting point, we have corporate income taxes, and the rate is the same, which is 30% for all the countries, Tanzania, Kenya, Uganda, and Rwanda. On employment taxes, we've separated between the taxes that are paid by the employer and taxes that are paid by employees. On taxes by employer, for Tanzania, we have a social security contribution of 10%, we have skills and development levy of 4%. We have workers' compensation fund of 0.6%. And for Kenya, we have social security contributions of a nominal amount. So the contribution for Kenya is capped at $2. And for Uganda, we have social security contributions of 10%, and Rwanda is 5%. Sorry, is someone speaking?
Adrian, you can mute
Okay.
Hannah. Hannah is disrupting John Yam.
Thank you. I'll proceed. So if you look at the taxes on employer, the rate for Tanzania in total for the contributions, the various contributions, is quite high at 14.6%, where Kenya, as I mentioned, the total is just the social security, which is capped at $2. And then Uganda, the total is 10%, and Rwanda is 5%. When we are talking about the proposal in the later slides, we're going to see one of the proposals that we've presented to the government in relation to the taxes for Tanzania, or the contributions rather for Tanzania, because we find this to be quite high compared to the region. On taxes on employee, the top marginal rate for all the countries is almost the same. So 30% Tanzania, 30% Kenya, 30% Rwanda. Uganda is 40%, but on average, most of the individuals fall under 30%. So based on the maximum amount that is put, only few people fall under the 40% rate. So generally, you can say the rates are a bit similar for all the countries within the region. Again, when you come to social security contributions for the employees, you see that the rate for Tanzania is high at 10%, whereas you have 5% for Uganda and 3% for Rwanda. Again, Kenya is the nominal amount. So you see, again, if we look at the total contribution, social security contribution, without considering other contributions, so the total for both employer and employee, Tanzania is at 20%, Kenya is the nominal amount, Uganda is 15%, and Rwanda is 8%. So as I said, we're going to speak about the proposals that we've put across in order to ensure that Tanzania is aligned with the rest of the region. Next, we have withholding taxes. Withholding taxes apply for different rates, different payments. The first payment is dividends. For dividends, the rate for Tanzania is can be 5% or 10%, depending on where the payment is made. So if the payment is made by a listed company, the rate is 5%, or where the payment is made to a resident company that is holding 25% shares in a resident company, the rate is also 5%. But in any other case, dividend payments are subject to 10% withholding tax. Uganda, the rate is 10% for listed securities and 15% for the rest of the payments. For Kenya, the rate is 5% for residents and 15% for non-residents. Rwanda, the rate is 5% for listed securities, whereas 15% applies in any other case. On interest payments for Tanzania, we do not, the rate is the same for residents and non-residents. So when you're paying interest, generally the rate is 10%. Of course, there are some exemptions which I do not want to go through given the time that we have for this presentation, but things like interest payments that are paid to banks are exempt from withholding tax, but the general rate for both payments to residents and non-residents is 10%. Uganda, the rate is varies. So for residents, it ranges from 10% to 15%, and then the rate for non-residents is 20%. For Kenya, the rate ranges from 10% to 20%, 25%, sorry. And then Rwanda for listed securities in the By the way, the listed securities for Rwanda, they consider other East African countries as well. So the 5% for dividend is for listed security in the East Africa community, and 15% for the rest of the payments. The same for interest. The 5% is for the entire community, whereas 15% is for the rest of the payments. For rental payments, we have the rate of 10% for Tanzania and Uganda. So the rate of 10% for Tanzania applies for both payments to residents and non-residents. However, for residents, the withholding tax only applies if the payment relates to buildings, land, or aircraft. In any other case, withholding tax does not apply. But for non-residents, any rental payment is subject to 10% withholding tax. Uganda, residents are not subject to withholding tax on rent, and non-residents are subject to 15% withholding tax. Kenya, residents are subject to 10% withholding tax, and the rate for non-residents varies from 15% to 30%. Uganda, the rate is Rwanda, Uganda, the rate is 1, which is 15% for all the rental payments. Royalty, Tanzania is 15% for both payments to residents and non-residents. Uganda, the rate is 15% for non-residents, and it does not apply for residents. And for Kenya, the rate is 5% for residents and 20% for non-residents. And Rwanda is the same as Tanzania, where 15% applies for both payments to residents and non-residents. On service payments, payments for service fees, which include management and technical fees, the rate for Tanzania is 5% for residents and 15% for non-residents. For Uganda, the rate is 6% and 15% for non-residents. For Kenya, the rate varies from 5% to 15% for residents and 20% for non-residents. And then Rwanda is 15% for all the services. Just to put a caveat, so these rates that we've put here are in cases where there are no double taxation agreements. So there are instances where if you have a double taxation agreement with another country, the rate could be reduced to a lower amount. And the last one that we have on the slide is insurance premium, where for Tanzania, it only applies if the payment has a source in Tanzania and it's made to a non-resident, and the rate is 5%. For Uganda, the rate is 15% for all the insurance premium payments. Kenya is 5%, similar to Tanzania, but then Kenya applies for all the payments. And then Rwanda is similar to Uganda, which is 15%. So we'll move on to other taxes, and I'll let my colleague Jafari speak on the rest.
Jafari is muted. What's happening, Jonea?
Sorry, come again.
I think your colleague is not is muted. Is muted. Is not. I don't know if he has a connectivity challenges.
Just a minute.
In the interest of time, I think you proceed, Jonea.
Hello, can you hear me? Yeah,
we can hear you.
Laptop. Can you hear me? Okay, thank you very much. Sorry, I've got some technical issues. So so my name, as introduced by Johnny, my name is Jafari Mba, and I'm in the tax line of services here at PwC Tanzania, and I'll be taking you through the two or three slides to come on other taxes apart from the income tax and the withholding tax that Johnny has already covered. So quickly, I'll take you through the VAT and excise. So as initially mentioned, we in the region where we all have VAT and excise, and it applies on different products. If you look quickly on the first row there, it shows Tanzania. We have two different rates for VAT. So we have 18% that applies in the mainland Tanzania, and 15% that applies in Zanzibar. For Uganda, they have 18%, Kenya 16%, and Rwanda we have 18%. So the 15% that is for Zanzibar is just recent, and it was a measure to what happened the COVID-19. But initially, the same rate was also applied in Zanzibar. For zero rate, the rate is the same. For exports, the rate is the same for Tanzania, Uganda, Kenya, and Rwanda is zero rate. For Kenya, zero rate applies on goods while services are being exempted when it comes to exports. So those are general rates for those that are applicable on local supplies and as well as exports. As far as excise duty is concerned, for goods, excise duty applies on several items, and these items are provided. So they are provided under different laws, local legislations. So there is a huge list for both for all countries. If you go to the local legislation, you find there's a huge list that shows what goods are excisable and at what rate. Yeah, so we couldn't cover everything here, but you find most of these goods we almost be the same for each country. And of course, as you may be aware, excise duty basically is there to sort of control the use of those particular goods. For services, things are different from country to country. For Tanzania, we have excise duty on fewer services compared to the rest of the region. For Tanzania, mainly we have excise duty applicable on telecoms as well as financial institutions. For telcos, there are two rates that are applicable as far as excise duty is concerned. There's what we call electronic communication services. This is your usual data and airtime. Excise duty applicable there is 17%. While if you go to Uganda, the rate applicable there is 15% is 12% for data and the airtime, while Kenya the rate applicable for data and airtime is 20% and Rwanda is 10%. But when it comes to money transfer, Tanzania we charge a rate of 10% as excise duty for money transfer. Uganda they have 15% for money transfer, but of course they also have an additional 0.5% on the value of the transaction at the time of withdrawing the money from the telcos. For Kenya, money transfer attracts 12%, while in Rwanda it's the same rate of 10% applicable to both money transfer as well as airtime and data. You see in Uganda there is another additional rate there of $0.09 per minute that applies for all incoming calls in Uganda. There's excise duty applicable of $0.09 per minute. When it comes to banks, so in Tanzania, banks are subject to excise duty on fees and commission at a rate of 10%, while in Uganda, they are 15% on fees and all charges. Rwanda 20%, I mean Kenya 20%, where Rwanda they do not have excise duty on financial institution. So the next slide there is basically to also speak around the comparison of what is happening within the region as far as the budget process is concerned. And I know the previous speaker mentioned that the reading of the budget was somehow agreed within the region to be done on this at the same time. But you'll note that while the budget is read probably on the same date, the process towards the reading of the budget may be different from country to country. So we thought it's important to also highlight the differences that are there between the process, between the countries as far as this process is concerned. So in Tanzania, we have what we call stakeholder submissions to the National Treasury. These are proposals that are supposed to be submitted by the stakeholders. So normally the process starts by getting an invite from the National Treasury for stakeholders to submit the proposals on what they think should be changed as far as that the upcoming financial year is concerned. So in Tanzania, we normally receive this around December, and then the process starts there. The discussions, the preparation of those particular submissions will start around that time, and the submissions is always done around the second week of February. So you do the submission by probably 10th of February, and then you'll get some discussions later on when the task force from the Ministry of Finance will invite people to come and discuss on their proposals, and then after that the proposal will be discussed at the think tank, and then wait for the bill. So the bill normally in Tanzania will come around mid-June, the second week of June, and then the Finance Act will come effective 1st July of each year. For Uganda, you'll see the process there for them starts a bit earlier, because they invite for the stakeholder to make those submissions starts around around September, and it runs up to February. So they have a little bit more time to gather the proposals and make those submissions. And then they get a chance to do a discussion, which is done by end of March. And then there is also stakeholder submissions to the National Assembly or Parliament, which is done around March to April. So from the discussions that are done at the National Treasury level, there's also some other submissions that are supposed to be done by the stakeholders after the discussions that are held around March. Then there's other submissions to be done between March and April. And then you have other discussions that are supposed to take place around March. The finance bill will come out around March to May, thereabout, and then the discussions and everything. But then we expect to get the Finance Act effective from 1st July of each year. Similar to Kenya, similar to Uganda, Kenya is also the process starts around September, and then submissions are done up to November. There's some discussions done around December. Stakeholder will also be allowed to make further submissions to the National Assembly between April to May. Then you will discuss those submissions around May, and then the finance bill will come. Of course, the submissions are done in May will be in respect of the finance bill that will come around April, and then you have the act effective from 1st July. So as far as Rwanda is concerned, you will see we have put there not applicable, but I think it's important to invite my colleague from Rwanda to also speak around how the process is, because it's a bit different from the rest of the region. If you can come in, Messi, please take us through on what is happening in Rwanda.
Thank you, Jafari, but I would rather I cover this at my appointed time. it will be a bit of a discussion. So you just finish so I don't eat into your time.
Thank you, Messi. So I think, yeah, Messi will cover this later on when she's discussing about the budget proposals for Rwanda in the next slides. So the next part will be to discuss the proposed measures for 2020-2023, and we'll start with Tanzania, and then the rest of the countries will come in.
All right, thank you, Jafari, for that. I hope you can hear me.
Yes, we can hear
Jafari,
you. Can you introduce yourself?
This is Jonia. So I'm proceeding with budget changes, proposals for 2022-2023.
For Tanzania, okay.
For Tanzania, yes. And then once Jafari and myself are done with the proposals for Tanzania, our colleagues from other countries will also speak. Before I start, I think it's important to say that from Jafari's previous presentation, you will note that the budget process for Tanzania is a bit different from the rest. So at this point where you have, for example, bills or at least expectation of what is expected in terms of the changes for countries like Uganda and Kenya, we do not have we do not know what to expect from the budget. So while our colleagues will talk about what has been proposed or what is expected to come in the Finance Act, we're only going to speak about the changes that the proposals that we've made and which we think are going to be relevant for this forum. So the first one, actually, I would start with the previous slide, which Jafari was speaking about, which is the budget process. So it's important to make sure that the budget process for Tanzania is changed, and we've submitted the proposal in that regard. In that, if you look at what he was presenting, for example, the bill for Tanzania will come 2 weeks before the Finance Act is implemented. So we only have 2 weeks to make submissions to the government in relation to things that we feel are not should be changed, or to provide comments in relation to the finance bill. But at the same time, if for example, you have a change in a rate, say VAT rate, you only have less than a week or just a few days to change your systems to implement that change. So it's important that the process for Tanzania is changed so that stakeholders can be given enough time to provide comments, but at the same time to get enough time to implement any changes that are brought forward. So we've categorized the other changes under different tax types, and I'll start with tax administration. On tax administration, the first proposal that we made was in relation to primary data saver. And the Finance Act last year introduced the requirement to maintain physical data saver in Tanzania. So our interpretation of that is that if you have cloud system, for the purposes of complying with taxes in Tanzania, you still have to have a physical data saver. So where in the current world people are moving to cloud-based servers, we are kind of moving behind. But in addition to that, there are additional costs that come with the incorporation of that provision, whereby if someone is already using cloud, they just have to put in place a physical server for the purposes of complying with tax. So we feel that, and we understand that this change came in order to make sure that the Revenue Authority has access to data whenever they want to. We feel that this change is taking us back, and we feel like there could be ways, even with the cloud systems, that can be used by the revenue authorities to get the data that they want. So basically going back to the point of discussions with stakeholders, discussions could have been made before the change was introduced to see how the Revenue Authority can get data even with the cloud systems. So our proposal is, and this provision actually is supposed to come into effect from 1st July 2022. So we are hoping that an amendment will be made and time will be given to discuss to find a better way to implement whatever the Revenue Authority is trying to achieve. The next point is on clarity in terms of tax deposits required to when someone has been issued with an assessment and the object, we would apply for it, and the
Jonia, you are breaking. We can't hear
Hello,
you
can you
properly.
hear me?
You are breaking. Can you come back slightly?
Okay, can you hear me now?
Now we can hear you properly.
All right, I hope you had the first point, so I'll repeat the second point on deposit of on the objections.
Yes.
Okay. So I was saying, in Tanzania, when the Revenue Authority has issued an assessment, if you do not accept the assessed amount, you can object. But then the objection is supposed to be accompanied by a deposit. So in the past, you would make an application to the Commissioner General for the waiver of the deposit if you are not in a position to pay the deposit. And if the commissioner rejects the the waiver request, you would appeal to the Tax Revenue Appeals Board. Stating that there was an appeal that was issued by the Court of Appeal stating that the refusal to grant waiver is not an appealable decision. And therefore, the question is now, if the commissioner rejects a waiver request, where do I go? There's no guidance in terms of what process to be followed. We understand as PwC from discussions with lawyers that you can actually apply for a judicial review. But this, we are not aware of any legislation that provides for that. So what we are proposing basically is to get a clarity, or if a legislation can be passed that provides for the process to be followed if a waiver request is rejected by the Commissioner General. The next point that we are proposing for a change is in relation to an admission of objections and determination of objection. So like 2 years ago, a provision was passed that if the Commissioner General is not able to determine an objection, so when you get an assessment, you object, and then in the past, there was no timeline in terms of when TRA responds. But 2 years ago, a provision was passed that if the commissioner does not respond, needs to respond to the objection within 6 months, and if they do not respond within 6 months, then the assessment, not the objection, the assessment is considered to be final. So you see that that is unfair because it's failure in the side of TRA to respond within time, but then you are punishing the taxpayer by saying the assessment has to be final, while the taxpayer has filed an objection and the objection has not been considered, and one is considering the assessment position as final. So we are saying that cannot be right, and in a way, it cannot motivate the Revenue Authority because they cannot just decide to wait for the 6 months to expire and then the matter will go for appeal. So what we're saying is it's good to give timeline for to the tax authority, but then an amendment should be made in a way that if TRI is not able to respond within 6 months, then the taxpayer's position, which is the objection position, is considered final. Another issue in relation to that is that it says the 6 months is from admission of an objection, but then the law does not really state what an objection is. The law does not state what an objection is, sorry, what an admission is, and the law does not state what an admission is. And so in some cases, some of the tax authorities would actually issue a letter as a basis for admission. But other officers would say, okay, once you've met all the conditions that are required, for example, payment of deposit, and you file the objection on time, that will be considered as admission. So you find that a taxpayer will be confused in terms of when do I start to count the 6 months? Is it when I get a letter from TRA that the objection has been admitted, or is it when I make the deposit? So what we are proposing here is to have a clear legislation or provision that says what amounts to admission of objection. So other changes are in relation to SDL, which is Social Skills and Development Levy, and Workers' Compensation Fund. So this is the point that I said I was going to speak to on when I spoke about the different rates that apply on employment taxes. So we are proposing for reduction of rates so that at least Tanzania can be, the rates in Tanzania can be comparable to the rates that apply to the rest of the region. And we are proposing for the reduction of the skills and development levy from the current 4% to 3%, and then abolition of the workers' compensation fund, so which is currently at 0.6%. And once the skills and development levy of 3% is collected, it can be allocated between vocational and education training contribution, which is the 3% between SDL and workers' compensation fund between 2% and 1%. And then if a company makes turnover of less than 200 million, we are proposing that SDL should not apply, because this is to encourage small and medium enterprises. And also generally, apart from aligning with the rest of the region, these changes will actually encourage employment in Tanzania, which is currently an issue. Again, we are proposing for a reduction of rates for social security contribution for the same reason, to align with the rest of the region. So instead of having 20%, we can have 15% and probably 10% contributed by employer and then 5% by employee. That's all from me for now, and I will welcome my colleague Jafari to proceed with the rest of the proposals.
Okay, because with the interest of time, we requested Jafari to quickly make the presentation so we can have a presenter from the other country. Please, Jafari.
Yeah, so thanks, Junior, and thanks for this. So I'll just take you through this one slide that I have. So for Tanzania, as far as other taxes are concerned, we also had proposals that we had submitted, and one of those is to do with VAT. And for VAT, we are saying there should be an fees. Currently, there is VAT applicable on those, and in order to boost the tourist sector, I think this proposal may be good to be taken into consideration, so that we can boost that sector. Junior mentioned something around small and medium enterprises, and I think there's a VAT registration threshold there. We're proposing for it to be increased to is 100 million shillings, and we have the view that if this is done, if the increase is done to 200 million, it will mean that we're reducing compliance to small and medium enterprises, and of course, on the other hand, the government will be benefiting on getting the input tax that was initially claimed by these small and medium enterprises by the virtue of being registered persons. So for excise duty, there is a huge proposal there where we are putting. We're saying there has to be an overhaul of the entire Excise Duty Act, and it's because if you look at what we presented before on the domestic taxes, you'll see in Tanzania, with the excise duty on services only applies to two items, but it's because initially the act, the way it's drafted, it was to only cover goods, and we have been seeing some insertion from time to time on services. And since there are fewer insertions on services in the act, there has been some problems or issues, interpretation issues, as far as those applications are concerned, because the act was drafted around goods, and it was initially applicable to only goods. So now the way the service provisions have been inserted, they are bringing some issues as far as the interpretations is concerned. So we think it's time. We've seen Kenya, they have a new excise duty act. I think even for Uganda. So it's time for also Tanzania to come up with a new excise duty act that is current, is going with what is happening, the trend and everything, and also trying to cover that issue that we see currently with the interpretation issue. Otherwise, if that is not done within this year, we are looking at the quick wins there. We can start by looking into the excise duty rate that is applicable on telcos. Currently is very high at 17%, and we think there is a need to relook into that and probably revise that to at least 10%. As far as excise duty on services is concerned, there's the issue to do with supplies made to intermediary. Currently, there is a lot of issues that we are facing with the Revenue Authority, where they want to charge excise duty on what is supplied to intermediary, as well as what is supplied by the intermediary to the final consumer. The law, the way it's worded, as I said, it was only to cover goods, and there's a provision that covers goods, which says that accessible goods cannot be subject to excise duty more than once, but services has not been covered. So it may be important to also probably update the current act by including a provision which also covers services to not be taxed more than once. We also need a clarity on when it comes to export of services. The law does not speak of export of services currently. It only speak of export of goods. So there is a question of whether excise duty should apply on export of services. In practice, we've seen the Revenue Authority agreeing that it should not apply, but it may be important to have it legislated so that it is clear to everyone that export of service should not attract excise duty. The other proposal there is on the digital services from non-residents. As we are aware, there is that urge for the government to look into how they can expand the tax base, and they have been looking into how they can collect tax from the digital service providers who do not have fixed place of business in Tanzania. And the question was is around what is happening elsewhere. And in our view, our proposal is to look into what the multilateral solution is providing. Currently, Pillar 1 of the inclusive framework, and I think we think it's important to wait till that is resolved and we have that solution as far as multilateral is concerned, instead of going for the unilateral initiative, which is a DST. In any other case, we are looking at the quick win, and for us, since the VAT Act provides for taxation of digital services, it may be important to first of all look into how they can implement the provisions that are already in existence in the VAT Act before they look into other provisions or introduce new provisions while the existing provisions have not been implemented to date. On the other hand, we are saying while our proposal is to wait till to wait for the multilateral solution, in case the government is thinking of introducing DST in Tanzania, it may be important for the draft legislation to be shared with stakeholders for comments as early as possible before the important to also hear about the stakeholders and the effect of DST as far as the businesses are concerned. So I think that marks the end of my presentation. I welcome someone from Kenya to take us through on the proposal that they have on their end. Andrew or Hannah, please. Welcome.
Okay, thank you very much, Jafar. Now we go to Kenya. As Jafar said that he welcome Hannah or Andrew. So please, because of the interest of time, also I think in area where the other presenter has made a presentation, please try to go to the new areas where we have not had. Andrew and Hannah, karibu. Jaffa and Jonia, can you end the presentation, or is the same presentation which is continue?
Yes, we are using the same.
Oh, okay, thank you.
Hello, just please confirm you can hear me. Okay, so
yes,
my name
we
is
can
Andy,
hear you.
and I'll be taking you
through the
Kenya presentation in terms of tax administration and income tax changes. I'll be assisted by Hannah, who will be taking us through the indirect VAT changes. So in terms of the major issue that has occurred, and something else to mention is that unlike other countries, as it was mentioned by Johnny, we already have a finance bill and we expect to have an act by the end of this year. In terms of one of the major changes is that there is a requirement to introduce a 50% deposit to be paid if you want to appeal to the High Court. This previously wasn't there, and it has brought a lot of it's been in the media a lot, and I think most of the people in this call have seen it. Since it will, I know it's a practice that is around in the other countries, but in Kenya, this is a new change. And it's something that would affect taxpayers who are trying to seek for justice. In terms of another change that has been brought about is there's a requirement that our revenue authority, which is the Kenya Revenue Authority, has to issue a valid objection to a taxpayer within 60 days. What usually happens is once an assessment is raised in Kenya, the assessment is reviewed by an independent review office, which usually before the 60th day usually used to request for additional information, and as such it was being exploited by the KRA to delay decisions. So this change is meant to ease the process and allow taxpayers to be able to get a decision within 60 days. Another change on tax administration is that there is a requirement for taxpayers to be notified within 14 days if an objection is not valid. Because most cases they used to keep quiet and no requirement was being brought about. The other notable change that is being proposed by the finance bill is that taxpayers will be able to use installment taxes that were overpaid in the previous year to be utilized against future tax liabilities. This was previously not there, and taxpayers were required to do a refund. And once the refund process used to take so long. So with this change, it will allow for taxpayers to be able to automatically offset installment tax payments. Another notable change is that the period of which refund for overpaid VAT has been changed from 12 months to 6 months. For other taxes, it's 5 years, but they've reduced the period, and which is something that when we are making public presentations, we had also notified that the 12-month period should be retained. Another good change is that taxpayers are now, who have paid tax in error, are now eligible for a refund. Previously, there was a lacuna in the law, and people are treating tax paid in error as overpaid tax. But now with the clarification, this is a welcome move. Another notable change is on the security on property for unpaid tax. Previously, this was only restricted to land, but now they have included other movable assets such as ships and vehicles. And the Revenue Authority has the authority to put a charge or to stop the transfer of certain movable assets. Another change is on the Statutory Instruments Act, where there's a proposal to amend it so that tax regulations are not subject to the automatic expiry, which is at 10 years. And the statutory instruments in this case are legal notices, for example, legal notice 90 and 91 on withholding tax exemptions to power producers. So these are welcome move in that it will prevent the jargon of having to present this back in Parliament. Now, moving over to capital gains tax, this is a big change in that they want to change the capital gains rate from 5% to 15%. We note Kenya has one of the lowest rates for capital gains tax, and I think that's one of the main moves that they try to increase the rate for parity within the region. Another change is on withholding tax on gains accruing to non-residents from financial derivatives. This was previously not there, and now they have introduced it with the onset as our NSE is embracing other financial derivatives like forwards and futures, so with the hope of getting more revenue. Now, moving over to the next slide, I'll be taking you through the income tax changes. And under the income tax changes, there is a proposal to restrict the deductibility of forex losses that are thinly capitalized. This is just an amendment in the law, since this was there originally, but Kenya used to have a threshold of 3 to 1. Where they used to use the ratio of 3 to 1, where if your loans are more than your equity reserves by 3 to 1, you're thinly capitalized. Now they're moving towards an EBITDA model where it's 30% interest, 30% of interest, 30% of EBITDA is restricted. And this applies to all companies. So to align also the deductibility of foreign losses, they have now aligned the 30% interest restrictions. Another notable change is, as you've had the Tanzania presentation on digital service tax. We have had digital service tax since 2020, and they propose to increase the rate from 1.5% to 3%, given that most of the foreign players are now registered for taxes in Kenya. Another notable change is they have introduced the definition of a preferential tax regime. And this is any country, if you're doing business with an entity which is based in a country that has no tax paid or has a rate of less than 20% or does not allow for the exchange of information, has not signed up for that. And the reason why this definition is important is that these transactions will now be subject to transfer pricing, and they've expanded the scope for that. Something else that has changed is on country-by-country reporting. Of late, Kenya has been signing a lot of agreements to comply with the international agreements being signed. And one of the notable changes is the requirement for country-by-country. Previously, the wording wasn't proper in that it was only allowing for countries, entities that were headquartered in Kenya, that were operating outside Kenya, but now they've also included entities that are constituent entities of multinationals. And they'll be required to file a local and a master file. Something else which has also been a good change is the proposal to allow the deductibility of donations to charitable organizations. Previously, there were two conditions. You had to have an income tax exemption certificate, and second, you had to be either registered as an NGO or a society. This prevented companies limited by guaranteed or trust from claiming this deduction if you donated to them. So this is a notable change. Another notable change is the exclusion of microfinance bank from the interest restriction that I had earlier mentioned above, which is a good thing as it aligns to what is being carried out in the region. Also, there's some investment deduction that is allowable for power producers. Previously, it was only allowable to power producers who supply to the national grid, but the proposal is to change this so that even if you're you're a power producer, but you do not supply to the national grid, you should be eligible. Something else in terms of employees, they've changed the tax point for taxation of employee option plans from to exercise date. Previously, this was on vesting. So this is also a good move since it aligns to international practices. Other changes that have happened is the income chargeable to tax received by a trust is now taxable on the trustees. There were some exemptions that had come about, and there were restrictions in the amount of money that was tax-free to the beneficiaries. VAT proposals. Thank you.
Thank you, Andrew. So my name is Hannah Wanyuke. I'll take you through the changes proposed to the VAT Act before proceeding to the excise duty changes. So the first proposed change by the Finance Bill of 2022 is the Finance Bill has proposed to include a clarification in the VAT Act stating that VAT registration threshold of 5 million shillings is not applicable to non-resident suppliers of digital services. Previously, the VAT Act was silent on the applicability of the VAT registration threshold of 5 million to non-resident suppliers of digital services supplied through a digital marketplace. So this means that the non-resident suppliers making taxable supplies through a digital marketplace will be required to register an account for VAT regardless of their turnover in Kenya. The next proposal is on deduction of input tax. So the Finance Bill has proposed to empower the Commissioner to request for additional documentation while validating the input tax deducted in a VAT return. This is as a result of the recent VAT auto-assessment, where we saw KRA requesting for additional documents, which included a statement of accounts, contracts, proof of payment, etc., while validating input tax claimed. Currently, under the VAT Act, you're only required to hold an invoice or a certified copy of an invoice, a customs entry, credit notes, or debit notes, as the case may be, for purpose of deducting input tax. In the next proposal, so the Finance Bill has proposed to exempt from VAT plant and machinery imported by manufacturers or investors in the manufacture of pharmaceutical products. In addition, there is also a proposal to exempt medical consumables such as oxygen supplied by registered hospitals, urine bags, adult diapers, and colostomy bags. So this will spur investment in the pharmaceutical sectors. So the Finance Bill has also proposed to remove a VAT exemption on goods and services used in construction and equipping of specialized hospitals. In addition, there is also a proposal to remove a zero-rated status on certain supplies and clinics. So this proposal is inconsistent with the government's Big Four agenda on universal health care. The next proposal is about, so the Finance Bill has proposed to exempt from VAT inputs and raw materials for local manufacture of passenger motor vehicles, and has also proposed to exempt from VAT locally manufactured passenger motor vehicles. And this is aimed at encouraging investment in the local motor vehicle manufacturing sector. The final proposal under the VAT is that the Finance Bill has proposed to have interest and penalty on late payment of import VAT calculated by the provisions of the Tax Procedures Act. And so under the Tax Procedures Act, late payment interest is calculated at the rate of 1% per month, and the late payment penalty is calculated at the rate of 5% per one-off, as a one-off payment. In addition, the induplium rule will also apply. So this is a welcome proposal because interest calculation under the East African Customs Community Management Act has been a bit punitive since it applied at the rate of 2%. Now, under excise duty, the finance bill has proposed to increase excise duty rates for various goods. So I'll name just a few of them. Some of them are the fruit and vegetable juices, the cosmetics and the beauty products, bottled and the bottled water and other non-alcoholic beverages. So the proposal to increase excise duty will result in increase in the price of various commodities, and I feel that this is driven by the push for additional revenue for the government. In addition, the finance bill has proposed to increase excise duty on amounts paid to participate in betting, gaming, and competition prizes and lotteries. And this is from the current rate of 7.5% to 20% of the fees paid. The next proposal is to widen the tax base for excise duty. And this is by introducing excise duty on fees paid on advertising of alcoholic beverages, betting and gaming, lottery and prize competitions by television stations, print media, billboards, and the FM radio stations. The fees will be subject to excise duty at the rate of 15%. This therefore means that the media companies will be expected to register So the other proposal is to introduce the introduction of excise duty on ice cream at the rate of 15%. Excise duty has been introduced on locally produced glass bottles at the rate of 20%. It is expected that this will increase the cost of goods sold, and as it also raises the additional revenue for the government. So the bill has also proposed to empower the Commissioner General to exclude specified items from inflationary adjustment based on prevailing economic conditions. In this case, the Commissioner will review the current economic and social circumstances affecting certain products before effecting inflationary changes. A good example is on the high fuel prices in Kenya, and the Commissioner, in which case the Commissioner is expected to review the current status before and exempt Finally, the finance bill has proposed that interest and penalties on excise duty payable on imports will be calculated as per provisions of the Tax Procedures Act. And just as I stated under the proposals for the VAT, under the VAT Act, so this will involve calculation of interest on late payment at the rate of 1% per month, and a one-off penalty at the rate of 5%. In addition, the induplium rule will also apply, where interest charged is not expected to exceed the principal tax that is outstanding. So as I stated at the VAT Act, this will be a welcome proposal, since interest and the calculation of interest under the provisions of the East African Customs Management Act is high and is quite punitive. I now welcome my colleague from PwC Uganda to take us through the next session.
Good day, everyone. My name is Trevor Lukanga Bwanika. Junior, could you please confirm if you can hear me?
We can hear you. We can hear you very well.
All right, thank you very much. So in the interest of time, I'll just run through most of the income tax changes. So just as I mentioned, my name is Trevor Bwanika Lukanga. I'm a senior manager at PwC Uganda. I'll be joined with my colleague, Julie Najinda, also, who's a manager and will present on the indirect tax changes. So quickly going into this from a Ugandan perspective, just like has earlier been mentioned. So our cycle goes all the way from September to about June. Then an act would come into force effective 1st of July for each year of income. So this time around, the proposals that have been brought about from a direct tax perspective are in twofold. One, those that affect the collection of taxes, and the other really from an income tax perspective. So the summary before you there in terms of the tax administration, that's a summary of penalties that have been introduced. But the key takeaway is that all those are going to be administered, or the proposal is to be administered as offenses. In other words, one will have to first commit the offense for that penalty to apply. In terms of the income tax changes, we've highlighted some of the changes there. So one is the definition of a beneficial owner, which the government is proposing to broaden. However, from a larger perspective, it does not change the fact that a beneficial owner from a Ugandan perspective is restricted to an individual person. So we still find that this definition does not really apply to an international tax environment, especially where double taxation agreements are being applied. So we've been having discussions with the government on this matter, but the definition has remained the same. So moving on to the other changes, well, they've included research institutions as part of organizations that are eligible for exemption. Then there's been, in terms of the rental taxes, the changes there is in respect to one, in the taxation of individuals, and the other would be non-individuals. So in the past, at an effective tax rate of 7.5 was applicable, whereby 75% of expenses would be allowed a deduction, and 25% would be subject to tax. So giving an effective tax rate of 7.5%. So what this change is now suggesting is that the change, a 12% rate, is going to be applicable to individuals. And what that means is that the individuals will not be eligible to deduct any other expenses. So you pay 12% on the gross rental income. However, for corporates or companies, then they would be paying tax at a rate of 30%, but the allowable expenses have been capped to 50%. Jonia, the slide is off. I was using your slide.
Yes, someone removed Jafari, so we are sharing.
Yeah.
Okay, it's back.
Okay, thank you. The other change is to do with withholding taxes on cargo that is embarked in Uganda by non-residents. There is an ongoing matter in court whereby TAT had ruled that there would be withholding tax on cargo embarked in Uganda by non-residents. So to clarify the matter, a change has been proposed in the tax law to ensure that withholding tax does not apply, but a question still remains as to what happens to the past periods. Then the other changes around the incentives, a hospital incentive has been hospital developers. There's been an introduction of an incentive. Then the other one is the incentive for manufacturers, which there's been clarity in terms of how it's applicable. So the incentive will be running for a period of 10 years. That's effective 1st of July, 2018. So what that means, if you apply today, then you would only be left with a period of about 6 years, because then the exemption kicks off from 2018. Then lastly, regarding withholding tax, there's been a question around withholding tax on business assets. So the government has clarified that the business asset in question relates to land, and therefore withholding tax will be levied in instances where a business asset, that is land, is sold. However, the other clarity that comes through is that the withholding tax will not apply where there is an exemption for withholding tax, or where such land is being used for business, is being used as a business asset by someone who's dealing in a rental business. So that's really it from a direct tax perspective. I would like to hand over to Julie to take us through the indirect tax changes. Thank you very much.
Thank you, Trevor, and good afternoon, everyone. My name is Juliet Najinda. I'm a manager in the Indirect Taxes Unit at PwC Uganda, and I'll quickly walk us through the changes in VAT and excise duty that we expect to see come through on 1st July. So from a VAT perspective, the changes this time around were not that many, and they all speak to making amendments to the exemption regime or the zero rating regime. So the first change that we are seeing that has been proposed is that where you have a company that is importing exempt supplies, currently we have had a provision that allows for those services to be exempted from VAT, but government is now proposing to repeal that exemption, which means that if this is passed into law, then companies that are providing exempt supplies, if they are importing any service that's not ordinarily exempted from VAT, then they'll also have to pay VAT on imported services through the reverse charge VAT mechanism. Then the other changes we are seeing around the expansion of the VAT exemption regime to include various things like the assistive devices for persons with disabilities. We're also seeing the supply of airport user services charged by CAA being proposed to be exempted from VAT, and the supply of oxygen for medical use as an addition to the exemption regime. Then currently we have an exemption that applies to investors that invest at least $5 million in hospital projects that are of national referral capacity. But now government is proposing to remove the requirement for that hospital to be a national referral. And they're saying that for as long as you're investing $5 million into a hospital project that will provide specialized medical care, then they'll exempt you from VAT. Then for the zero rating regime, we see that there are some products that are being moved from being exempted to zero rating to encourage promotion of those industries, because when we have products being zero rated, then it means that those manufacturers can claim the input VAT attributable to those products. So here we see the menstrual cups, the sanitary towels, the tampons, which were previously exempted from VAT, being moved from the VAT exemption regime to the zero rating regime. Then moving on to excise duty. Jafari, if you can just go to the next slide, please. Yes, so for excise duty, again, we've seen a number of changes that have come through for excise duty purposes, affecting the alcoholic beverages and other non-alcoholic beverages, as well as other products. So for the excise duty regime, one of the key changes we have is the proposal to decrease excise duty on opaque beer. And here the government is trying to promote the production of this beer in the country. And then we also have a proposal to exempt from excise duty and denatured spirits that are used in manufacture of sanitizers. So again, this is intended to incentivize those industries that produce such sanitizers by taking away the cost of excise duty. Then the other one is the limitation of application of excise duty to paper bags that are harmful for the environment, because what we previously had is that excise duty was being applied to all plastics and plastic granules, which then ended up taxing almost every plastic product on the market, which wasn't the intention of the law in the first place. Then the other thing is that government is extending the exemption of excise duty to incoming calls from Tanzania. This has been currently within the East African region. It's only Tanzania that has this excise duty of the $0.09 applying when Ugandans receive calls from Tanzania. So with this exemption, we expect that making calls will be cheaper because there's from Tanzania, because there's going to be an exemption from excise duty. Then as part of government's effort to encourage strategic investments, we are seeing a reduction, a proposal to reduce excise duty on products that are used or inputs to projects that are strategic in nature, by reducing the threshold from 50 million to 35 million for non-residents and to 5 million for residents, $5 million. So where a person, either a non-resident or a resident person, meets this threshold, then it means they would be entitled to an exemption of excise duty on all excisable inputs that they use in that project as part of their investment. So those are the key changes that came through for excise duty. I'll invite my colleagues in Rwanda to take us through the changes there. Thank you.
Thank you, Juliet. This is Mercy Ndirango, speaking out of Rwanda. I'm a manager in the tax department. Mine is going to be the quickest so that we can play catch up on the lost time. If you remember when Jafari was presenting on the budget process, with the had not applicable for Rwanda. And I'll give a brief background on why we had the not applicable before I give a brief comment, yeah? So unlike the regional, the neighboring countries where the system is very clear, you have the finance bill that comes in, you get proposals, this sit into the finance bill, and then later we have a finance act. We don't have this in Rwanda. Ours is slightly unique, where our proposed measures, our tax measures, if any, they hardly, if ever, will come in through the budget process. There usually will be a change in the law, and this can happen in the course of the year. It doesn't have to be at the budget time, yeah? So that's why it was very hard to give the timeline, seeing as we could have a change in the law happening, say, in August, yeah? So as we speak, we actually have 3 laws that are at parliament level, and we're looking at the VAT Act, we have the Income Tax Act and the Tax Procedures Law. These are under discussion already, they're at parliament level. So we wouldn't have what our colleagues in Tanzania, Uganda, and Kenya are presenting, where we are saying these are the proposed measures we expect to see coming in through the budget, because we don't have these. We have already gone through the process of the 3 laws that we are seeing under discussion, and these have been under discussion for the last, I think, 2 to 3 years. So that's why it was not possible to give that flavor. So we don't expect any tax measures to be coming in through the budget in June. So what we've done is we've taken just a few of the items that we feel are of interest. And somebody needs to mute themselves. I don't know whether it's Juliet, please mute yourself. Or is it Hannah? Okay, thank you, Hannah. So we've picked 3 items that are of interest to this group. We hope they're of interest, just to give you a flavor of what we're expecting to be passed. But as a disclaimer, these are not proposals. As seeing as these are draft laws that are already under discussion in Parliament. So we're just expecting them for gazettement anytime, yeah? But given the comparability factor of it, we'll talk to these 3 items. Now, we have a very interesting one under tax administration where starting December 2021, we've already seen these come into play, sort of, although it's not fully implemented, where the Revenue Authority is looking to making our CIT, corporate income tax return submission, very efficient and painless, if I may use the word painless, where when the taxpayer logs into the RRA system, they find all the information that RRA is already privy to is already pre-populated. What information do I mean here? For example, our sales, our transactions in this market, they usually will go through our EBM process. So if I make a sale or you make a purchase, I have the EBM receipt. So RRA in the back office already have this information. They'll automatically pre-populate. So when I go in to submit my return, I'll find the purchases that are already supported by EBM are already pre-populated. On a monthly basis, another example, I'm filing my pay-as-you-earn information. So by the time I go to file in my CIT return, things to do with payroll information, at least most of it is already there. So the idea is, by the time this is fully implemented, we'll have taxpayers, you go in and the only thing you need to do really is do reconciliations and introduce the aspects that RRA has no visibility of. Things like, I would say what accruals, provisions, we would have foreign exchange gains and losses and things like those, yeah? So once this is fully implemented, it will be interesting. And hopefully our colleagues in Kenya, Uganda, and Tanzania will borrow some ideas from us. The next item that is in the income tax law that is under discussion is we're looking to revise our pay-as-you-earn bands. We've had the same pay-as-you-earn brackets from 2005. You can imagine what that has meant to the common mwananchi, yeah? So these we're looking to change. The change will not be overnight. I think we're giving it a 2-year period. Once the law is changed, the change will happen over a period of 2 years. And yeah, we are looking forward to that. I can imagine you're all looking forward to that. Last but not least, I've had a mention of the digital service tax mentioned by my colleagues. We do not have that yet in Rwanda, but it has been, there's a provision that is coming in the draft that we've seen, the draft that is currently seated in Parliament. Although it's coming with a slight caveat that as much as the provision is going to be there, it will come in with a transitional period. We are not sure of how long. We are waiting to see this come through. And just before I finish, there's something I should have mentioned. Like I said, the changes in law in Rwanda, if there are any tax measures, they'll mean the actual law itself or the legislation being changed, yeah? So we'll have the law come in, and then in the course of the year, we'll have what we call Commissioner General rules or ministerial orders as well. And these, they're not laws in themselves. They usually will come to maybe give a clarification in something that was not clear. And I'll give an example. We had our income tax law, we had an overhaul in 2018. When we got that law, since April 2018, I think as late as December 2020, we're still getting Commissioner General rules explaining aspects of what is stated in the law, yeah? So we're expecting, even when the current acts, the VAT Act and the Income Tax Act and the Tax Procedures Law, once they're issued by Parliament, once they are gazetted, we expect to continue receiving some CG rules, Commissioner General rules and ministerial orders to clarify what is premised in the 3. And I think I would want to pause there, seeing as Like I mentioned, we don't have proposals of what to expect. Back to you, Mr. Moderator, Adrian.
Okay, thank you very much, Messi, for the presentation from Rwanda. I also thanks all the presenter, starting with the Jonia and Jaffa, and all the other from Kenya and Uganda. Now it's time for questions or any clarification you would like to hear from our presenters. So we will take 4 questions, and then we will pose them to the presenter. Please, if you're asking question, try to be very brief and direct. And also, I think it is better to mention the presenter you would like to address your question. Now we welcome those who have question. You raise your hand, then we will allow you to ask question. Welcome. Any questions? Okay. We have some questions which has been sent to the chat room, and even some have sent to our phone. And this one go to Jonia and Jaffa, because you were making the presentation where you are comparing the country. And this is related to value-added tax. And they want to know the difference between zero-rated VAT and exempted VAT. Because we have seen, for example, while the other EAC partner state have zero-rated export of services, in Kenya, we see the instead of zero-rated, they have exempted it. What is the differences, and what are pros and cons of having zero-rated and exemption? That is one for Jonia. I've seen a hand. Steve, do you have a question?
Thank you very much, Adrian. I am specifically interested in the communication and maybe clarity from someone from Kenya who had put forth a few proposals in the current, in the proposed legislation, tabled legislation currently. And my basic interest was on beauty care, cosmetics products. And I did hear her mention of some proposals on ground. And though I didn't caption that well, and I tried to look back into the slide, I didn't see it anywhere in her slide. So maybe she could give me clarity in that. That is the field I'm in. Thank you.
Okay, thank you, Steve. I think Hannah will respond to that. You can lower your hand. Then we request if there is another one who can raise the hand and ask the question. Currently, we have 2 questions already.
Adrian, maybe for the interest of time, we start responding as we wait for other questions. No?
Okay, before you respond, there is another question from Clara, who wanted more clarification, I think, from Uganda on the withholding tax on Uganda embarked cargo. She's asking before the amendment, which maybe we'll go through in 1st July, what is the current status now? That is another question from Clara, and this actually go to Uganda. Also, we have Maureen Agut. Maybe you can be last for this session. Maureen, welcome for the question.
All right, thanks, Adrian. Just one question to Mercy of Rwanda. She mentioned that when a legislative provision is amended or there's a new act in place, the commissioner gives guidance notes. So I just wanted to know, what is the legal import of those guidance notes? Are they binding on taxpayers? And if, say, those are then are contradicting the actual act, what is the position? Thanks.
Okay, thank you very much. Maybe because I think there is someone as, if I'm not mistaken, a peace or something like that. Can you also ask the question? So at least we have a 5 question which will be responded quickly.
Yeah, thank you very much and good afternoon. I wanted to ask the reason behind on introduction of excise duty on glass bottles, because nowadays people are like manufacturers of these juices that that use tangawiz and all that. They use glass bottles. So I wanted to know maybe the reason behind introduction of the excise duty on glass bottles. Thank you.
For Uganda or for which particular country?
Tanzania is the one that presented on that.
Okay, thank you very much. Now I think we start with Jonia in terms of responding. And then we go to Kenya, Uganda, and Rwanda. Please, can you lower your hand? Welcome, Jonia.
Hello? Please confirm you can hear me, Adrian.
I can hear you very well.
Thank you. So yeah, so I think I will take the question that was asked on the difference between zero rate and exempt. I think I don't remember the person who asked the question, but yeah, so there's a very big difference in terms of the impact of exemption and zero rating. So in the law provides for what? 1 minute. I think I can hear myself. Hello?
We can hear you, Jaffa. Please continue.
Okay, because I think I'm hearing some. Okay, anyway, so what I'm trying to say is the law provides for what qualifies to be exempted. And if you go to any VAT Act, there's going to be a schedule that shows what is exempted. And when you are exempted, it means that you cannot claim the input tax that you are incurring. So if you're incurring input tax, but you're making exempt supplies, it means you cannot claim the input tax that you're carrying. But when it comes to zero rating is a type of taxable supply, but a rate used is zero. And the person who's making zero rating supplies is then enjoying the claiming of input tax that has been incurred in the process of generating those types of supplies. So you had in Kenya the zero rating export of goods, which means the person who is exporting goods will be able to claim the input tax that has been incurred to generate those goods. But then they're exempting services. So if you export services,
then you cannot claim input tax incurred in the process of that supply of those services. So that's the big difference. The big difference is a person who makes exempt supplies cannot claim input tax, while a person who makes zero rated supplies can actually claim the input tax that has been incurred. And in most cases, these people who are making taxable supplies, which are zero rated, they end up in a refund position. So since they're not charging any VAT, they will end up claiming the entire input tax from the TRA or any revenue authority, and therefore they will be in a refund position. So the revenue authority will refund them the cash that has been incurred as input tax in the acquisition of those purchases. And for those who are making fully exempt, so if they're making exempt supplies in most jurisdictions, you'll not be required to register for VAT in the first place, because you're not charging VAT and you're not claiming input tax, so you are considered to be the final consumer in the VAT chain. And I think you saw there's a proposal that was it in, I think it's in Uganda, where they say they are moving some of the exemptions to zero rating, and one of those was sanitary pads. So, and the idea to do that is because before, if you exempt an item, so let's say if you're making supplies of sanitary pads and sanitary pads gets to be exempted, it means you cannot claim your input tax. And therefore, if you are pricing that sanitary pad, you have to take into consideration the cost of the VAT that you cannot claim before you come up with the price. And therefore, if you say you're exempting an item, you are not actually giving an incentive. While if you are zero rating an item, you get an incentive by way that you end up not charging VAT at standard rates, but you end up claiming the input tax, and therefore you don't increase the pricing of that particular item. I hope I've tried to explain that the differences between the two.
Okay, thank you, Jaffa. I think also maybe you can respond also the question from from Peace, who wanted to know why there is excise duty on the glass bottle, because she was saying a lot of product like tangawizi now they are using the bottle. Maybe you can give some clarification.
Jafari, if I may take that, I think that is a question for Kenya.
Okay.
Yes.
Yeah, moderator, it's for Kenya. Sorry, I wrote in the chat box that it is for Kenya. Sorry.
Okay, maybe Kenya will respond that. Now we go to Kenya, because I think there is two questions for Kenya. One is that of the glass bottle, and the another one was where they didn't actually include some of the product which one of the participants wanted to ask. Kenya, please.
Okay. Yes, thank you, Adrian. So I think the first, I'll start with the first question. So what the participant wanted to know is the change that came through for cosmetics and beauty products. So the finance bill has proposed to increase excise duty on cosmetics and beauty products. And so the proposal is to move this from 10% to 15%. I hope that is clear.
Okay.
Yes.
Yes, clear. About the glass bottle?
Yes, so about the glass bottle, so previously only imported glass bottles were subject to excise duty at the rate of 25%. But now the finance bill has proposed to introduce excise duty at the same rate of 25% on glass bottles that are manufactured locally. This, I think, is to level the playing field for both those who buy these bottles locally, as well as for those who import them. But I also see a motive for raise additional revenue by the government. I hope it's clear.
Yes, that is clear. That is very clear because I remember even previously, there was some sort of discriminatory where the imported motor were charging excise duty, but the locally one was not subjected to excise duty. I think now we go to Uganda, where they were supposed to respond the withholding tax on the cargo. What is the current status compared with what is proposed?
Okay, thank you for that question. In terms of the current status, so what happened earlier was the URA sent out a letter to all the players in the industry demanding for that tax. However, within a period of about 2 to 3 days, that same letter was withdrawn. So in terms of the current status, we are aware that the URA has not gone on to demand that tax as of now, though there could be some instances where I think this process had already started and it could be happening for some of the clients, but from a general perspective, the URA has stayed application of any assessments or demands in respect to that withholding tax, as they await the court procedures because the matter was appealed at High Court, so we're still awaiting the verdict and final judgment. So for now, we've not seen the URA assess any tax. Thank you.
Okay, thank you very much. I think we go to Rwanda. We had a question from Maureen, if I'm not mistaken. I think Messi, you can assist us in responding.
Yeah, sure. Thank you, Adrian. Hi, Maureen. That's a good one. Like I mentioned, yes, the CG rules, or the what do we call them, public rulings that are issued by the CG, these are binding on the taxpayers. They are not law in themselves in the sense that they will not be called the income tax law. It will just be a public ruling explaining one aspect of the law. I'll give you a quick example. When we brought in the 2018 Income Tax Act, it said something with the you know, about the 2% capping on management fees. It mentioned that residents who are making payments to non-residents would be affected by that 2% capping of management, technical, and royalty fees. So the CG rule in this aspect came in to clarify that they meant non-resident related parties. So all he's doing is clarifying something that was not very clear in the main law. So yes, the CG rules are binding on taxpayers. Back to you, Adrian.
Okay, thank you very much, Miss, for the response. Maybe now also we have another round, which because of the interest of time, I can say is a last round of questions. And I can see Andrew Othiano, please be very brief and direct.
Good afternoon, Adrian. Can you hear me?
Very well.
Okay, thank you very much. First, I'd like to thank the East African Business Council for convening this meeting on Zoom. And the question is for the Executive Director of the East African Business Council. We know very well that the private sector is the engine for growth in this region of ours. To what extent, therefore, is the East African Business Council, which I have always known to be an excellent convener of the private sector, conducting research regarding this harmonization of taxation? From the presentations that have been made, we've seen a lot more discrepancy than harmonization, but feedback from the private sector from an in-depth research perspective is definitely necessary. To what extent is the EABC, which is the convener of the business community in East Africa, conducting research, not just to diagnose the problem, but also to find a prescription for it from the private sector? Thank you very much.
Okay, thank you very much, Andrew Othiano. Then I think we will be able to respond it, but can we have another questions? Okay, there is another question which I have received. One is asking from the presenter if you foresee in future any introduction of the environmental tax. That is one of the questions. Another question which actually go to Uganda is regarding the proposal to decrease excise duty on the opaque beer from 12% to 8% for ad valorem rate, or Uganda shilling 230 to Uganda shilling 150 for the fixed rate. And the question here is, which rate now is being used, the ad valorem or the fixed rate, or whichever is higher? That is the question number 2. I can see there is a, is it in Gez? Gez, please, can you ask the question?
I hope you can hear me. Well, thank you for all the presenters for the good presentations. My question is really a clarification on the presenter from Tanzania who mentioned about the VAT exemption on concession fees and park entry fees. Is this already applicable, or this is the recommendation that is being pursued? Secondly is on the same, we heard about property taxes and land fees. That was also cumbersome to the tourism sector in Tanzania specifically. I wanted to know if they have any information on that, if there is anything being done to address this issue. Thank you.
Okay, thank you very much. I think Jonia and Jafari have heard you. I can't see any hand, so maybe we start responding the question. Maybe we can start from Uganda. No, before we go to Uganda, I think Emma, you can bring the 4th question. Emma Wanjiru, karibu.
Okay, thank you. I'm asking from Kenya, and I'm just wondering, you know, in Kenya, and I guess in the other East African countries, there are BMOs, the business membership organizations, and all that you know, try to articulate the needs of the private sector. And I'm just wondering, to what extent does the East African Business Council engage with them, to push the agenda of the private sector? That's number one. Number two is the EABC. What's their involvement in terms of supporting the development of SMEs? Because in the private sector, I would see that there are the large corporations who are your members. Then there is the SMEs, where, what's your impact there, especially in as far as the SMEs are concerned? Thank you.
Okay, thank you very much, Emma. I think we start now. We welcome the presenter to respond the questions. We can start with Uganda on the proposed decrease of excise duty, and then we go to Tanzania.
All right, thank you, Adrian. For opaque beer in Uganda, currently it attracts excise duty at the higher of either 20% of the ex-factory price or 230 shillings per liter. So the Uganda excise duty regime has two rates for all products: the ad valorem rate and the fixed rate. And It's the higher of the two that applies to the different products. So the proposal is now to bring it down from 12% for the ad valorem rate to 8%, and from 230 shillings to 150 for the fixed rate, and the high of those two will now apply on opaque beer. Thank you.
Okay, thank you very much. From Uganda. From Tanzania, I think there were questions from guests on the VAT for the park fees, as well as the property tax, where he was asking, is it a proposal or has it already been adopted?
Hello, yeah, so hope you can hear me. This is Jafari from Tanzania, and I'd like to respond to both questions. So I think the first question is around the VAT exemption on concession fee and park entry fee. This is a proposal. Currently, these fees are subject to VAT at a normal standard rate of 18%. And in our view, this is making the industry a little bit expensive. And therefore, our proposal was to exempt those park entry fees, and therefore at least making it cheaper for people to get in. The second question was on property tax. I didn't get the part where he mentioned it is problematic, but I just wanted to understand how problematic, because the change that we have on property tax was on how it should be collected, and this came last year, where they said going forward the property tax will be collected via local meters. So if a person is buying electricity in Tanzania, we'll be paying automatically be paying the property tax through that purchase of electricity. And there were subsequent regulations that were issued, which were providing more clarity on how the collection should be done, and to try avoid double taxation of any individual as far as property tax is concerned. So unless we have a specific issue that is there on that, but yeah, so to just to summarize, there are regulations that apply on how you can collect the property tax, and in our view, those regulations really have come to clarify a number of things that we had initially when the law was introduced. There was another question, I think, around COP26. I'm not sure that was aimed at any country, but to give my general observation and what has been happening, I think yes, definitely we may see the environmental tax coming up in the future, given that there has been a lot of talk, discussions around ESG. If you can recall, in last year we had COP26 that was well attended by the UN members, and the big discussion there was around.
Okay, thank you very much, Jafari. And I think Jafari talked about Luku. This is how you pay electricity in Tanzania, and the long form of Luku is lipa umeme kadiri utumiavyo. So here the property tax is the way you pay for electricity for every month. That's where the government collect the property tax. Another question I think also may go to Tanzania, because you are doing comparison, is a general question where Banji was asking if we foresee the environment tax, maybe it will be in form of excise duty, VAT, or what. I think Jonia or Jafari, you can respond that one.
Yeah, so I think I'd started responding to that. So hopefully now you can hear me. I was trying to sort of give a general overview of what I think will happen in the near future. So as I said, definitely it's something that may come. It may be a separate tax, just to call it environmental tax, just similar to what is happening in South Africa, where they have specific tax for environment. And of course, the biggest aim there is to try take care of the environment. So depending on what you are using, what you're purchasing, what your materials you're using, or the kind of pollution that you are creating. There is a particular tax that you'll end up paying. So yes, if you ask me, I see that coming. I'm not sure when, but it is on the pipeline. I think that will definitely come in the near future. Yeah.
Okay, thank you very, very much. I think also we had two questions which were directed to EABC. One was from Andrew Othiano regarding what the EABC is doing in terms of research on the domestic taxes, because we have seen a lot of disparity. Currently, what EABC is planning to do is to conduct a study on the domestic tax in EAC. We are very glad we have received some fund from Coca-Cola, and we are going to conduct that study in EAC, where we are going to look the disparity and also actually coming up with how ideal we can harmonize domestic taxes. Maybe we can start with the excise duty, because according to EAC is a tax which they are planned to start with in terms of harmonization. We have already formed a working group on domestic tax at EABC, which actually it constitutes manufacturer, especially those who are mainly affected by domestic tax, like from alcoholic, from cigarette, and also service provider like telecommunications, and the Apex Board Association, and when we are talking of Apex Board, we are talking of like Tanzania Private Sector, Uganda Private Sector Foundation, KEPSA, and other stakeholders like tax consultants like PwC, KPMG. Those are representative from national who are member of the EABC tax working group for domestic taxes. That's one. Another question was from Emma Wanjiru, who wanted to know how EABC is engaging the private sector in EAC. EABC is an apex board of private sector in EAC, and we push for the interest of the private sector in the EAC integration process. So how we work, we are also a business member-based organization, and we derive the interest of our members, and our members are business association at a national level, as well as regional association, and also some corporate which have interest in the region. And sometimes you find some company actually they have a branch across EAC, so they are corporate member of EABC. And how we work, actually we work very close with the National Apex Association, which we call them as national focal point. So they harmonize their position at a national level, then they submit to EABC, and we come up with a harmonized regional position, which we usually advocate or push at the EAC. And we have observer starter at EAC, where we participate in all policy formulation, starting from the expert meeting to EAC Head of State Summit, where we present our issues. Regarding the SMU, we have very much special interest with small and medium enterprises, because they form a large part of the private sector in the EAC. And we have a special platform which actually guide the issue of SME and pioneering the interest of SME in EAC. But also we have some other platform, which, for example, they are biased to women, where we have a women platform for the cross-border women traders, where we mainly address issue of women. So ASME is part of our EABC activity. Currently, we are doing, for example, the platform of SME and youth online platform, which will bring together the SMEs and youth and trying to address the issue actually affect them. So those are our response to those two questions. Okay, I think today we have reached the end of our webinar on the domestic taxes. On behalf of the EABC Vice Chair and the Executive Director, I would like to thank the presenters from PwC in Tanzania, Kenya, Uganda, and Rwanda for a very, very interesting presentation, which actually has given us the insight of the disparity of the domestic taxes in EAC. And from there, I think we can say this is a beginning where we can appreciate the need to push for the harmonization of the domestic tax in EAC so that we can have a more harmonized tax regime, which maybe can stimulate intra-EAC trade as well as investment. And we can make the EAC as a single investment destination. So I thank all the presenters from the 4 countries. And also I thank the participant for their participating in this webinar, as well as for asking very interesting questions regarding the domestic taxes. So this is our beginning, not the end. We will continue engaging you and having the other engagement in terms of the taxes, not only domestic taxes, but also maybe the common external tariff. We know we are going to have a new common external tariff, the new structure, where we are moving from the 3-band tariff structure to 4-band. And I think we need also to sensitize people in that particular area. So we welcome those companies which are not members of EABC to become members of EABC, which is very easy. And my colleague actually has already written his email address, Mr. Zephania, whom you can contact. So please read our chat room and contact us if you want to become a member. I once again thanks you very much. Asanteni sana.
Thank you, Adrian. Bye.
Thank you, all of you, the presenters and the moderator.
Thanks. Bye, everybody.